Happy Friday and welcome back, folks. Our tech director, who happens to be my wife, Irina, has taken efforts to jazz things up a bit with our video technology. Hope you like the new look, and we're probably going to play with a few different backgrounds in the coming weeks. Feel free to comment on a favorite if you have one. All right, so this week there are five stories that I think matter more than daily headlines. Individually, they're important, but together, I think they paint a picture of where the economy, markets, and technology may be headed as we move forward. So let's start, importantly, with the markets. They continue holding up despite a long list of concerns. The resilience is impressive as both the S&P 500 and Nasdaq are on track for weekly gains and both are near record territory. This despite volatility in semiconductors, oil, inflation concerns, and the renewed conflict in the Middle East. Now, the next major step begins next week, or test, I should say, as second quarter earnings season gets underway. Expectations are high, with analysts looking for year-over-year S&P 500 earnings growth of more than 23%. Now, on the one hand, that's encouraging. On the other, this means companies have much less room for error to not disappoint investors. However, expectations were likewise very high for the first quarter, and yet over 85% of S&P 500 companies reported earnings that exceeded those expectations. If that repeats, we're going to continue seeing rising stock prices while they're getting cheaper at the same time. Folks, that's an unusual and comforting setup. Second major story remains inflation and the Fed. Next week's CPI report and retail sales data will be critical in the short term. Investors are still trying to determine whether inflation is beginning to cool or whether it's going to continue remaining stubbornly high. This will increase fears of a rate hike if it does. However, much of today's inflation stems from things like tariffs, energy, electricity, semiconductor shortage, infrastructure investment, etc. My own view remains that the Fed is ultimately going to look through much of these as they aren't demand-driven inflation pressures, that higher interest rates are really going to have any impact on solving. The third story is AI and semiconductors. AI and semiconductors remain both a tailwind as well as a source of increased volatility. For the past few years, it's been the Mag 7 stocks that have been key to market leadership and direction. This year, markets have broadened out, and those companies have been left behind a bit with chip stocks taking over the lead. The Mag 7 itself, however, is beginning to show renewed strength, and I continue to believe that that group should perform well, if not very well, for the second half of the year. The growth we've witnessed in the semiconductor industry, however, has been historic. Revenue growth has been extraordinary. Earnings growth has been equally remarkable. Yet despite tremendous stock price appreciation, many of these companies are cheaper today than they were a year ago because earnings have been growing even faster than share prices. Nvidia is a very good example, following one of the most remarkable runs in market history. Its valuation is actually lower today than before the AI boom, cheaper when measured by earnings multiples. Now, investors continue to worry, however, that chips are ultimately a cyclical business. And the concern is that once supply catches up with demand, prices will collapse. And we saw that play out with devastating results during the dot-com boom. But like so much about the dot-com era, I'm not convinced that that's a good comparison to today. The chips powering artificial intelligence today are fundamentally different products. They're significantly more complex, far more expensive to manufacture, and demand remains and looks to continue to be exceptionally strong. Building advanced AI processors and high bandwidth memory isn't comparable to manufacturing commodity PC memory from 25 years ago. That doesn't mean triple digit growth is going to continue indefinitely. It won't, but it doesn't have to for these stocks to continue to move forward. The AI industry in its current form is like the Wild West, mostly unregulated and with an unknown future. And that makes a lot of folks, including investors, nervous and generates a ton of volatility. Now, I've been optimistic about this technology from the beginning. The longer term science fiction type implications are difficult to contemplate right now. However, from a job, productivity, stock market standpoint, etc., I think we will all be pleasantly surprised over the next few years. Already, many AI executives have shifted their viewpoint on jobs. Just a few months ago, many of them were offering cautionary warnings that the technology could well be a job killer, possibly a devastating killer. Now, just a few months later, most are suggesting that the new technology is going to be a boon for jobs markets, creating an untold number of new, exciting job opportunities. Time will tell, but I tend to lean toward the latter prediction. Now, the possibilities in medicine, health, longevity, etc., it's also very exciting to contemplate. And for my industry, it's going to create new challenges, hopefully, as retirement income may need to last longer than anticipated. Over time, maybe significantly longer. Would be good news on the one hand, challenging on the other. The fourth story is renewed hostilities in the Middle East. Earlier, I mentioned that the biggest macro issues remain inflation and the Fed. Directly impacting those issues is the conflict in Iraq. Hostilities resume this week, so far, however, with little impact on markets and oil prices. Finally, travel. Business travel, international tourism travel continue to recover, I should say, particularly across Asia and Europe. Now, while this may seem unrelated to investing, I see travel as one of the better real-time indicators of economic confidence. When businesses are investing in conferences, expanding internationally, and consumers continue spending on experiences, it tells us something meaningful about the overall health of the global economy. Unfortunately, the consumer confidence numbers from the government have, like pretty much everything these days, become political and unreliable. Real-time experiences create a more accurate picture, and that picture continues to look bright. So where does this leave us? For me, these five themes remain the same: earnings, inflation, the Fed, AI, geopolitics, and the health of the overall global economy. These headlines will continue to change week to week, but these themes are likely to drive markets for the foreseeable future. As always, all things considered, I remain optimistic over the long term. I see no significant headwinds at this point to derail the current scenario. But there will undoubtedly be volatility, there always is, but history has consistently rewarded patient investors who focus on fundamentals rather than headlines. Thank you for joining me this week, folks. I appreciate your time, and I do look forward to seeing you again next week.